Welcome to Bankless, where we explore the frontier of internet money and internet finance. This is how to get started, how to get better, and how to front run the opportunity. This is Ryan Sean Adams. I'm here with David Hoffman, and we're here to help you become more bankless. Guys, there is a massive opportunity. We've called it $1 trillion opportunity in the layer 2 world. We want to unpack it, and we're going to do that in 2 parts, in 2 episodes. The first episode is the one you are about to hear. We're going to talk about Ether economics in this episode. What do L2s, the coming of L2s, do for the price of ETH? Is it beneficial? Is it parasitic? Will we actually get in a layer 2 season with layer 2 tokens? We unpack all of that. In tomorrow's episode, there's going to be a part 2 where we talk about public goods, how they're the killer app of these layer 2s, how you can work for these layer 2s and work and to receive public goods funding, and how layer 2s will ultimately win the battle for hearts and minds using public goods funding and economics. David, that episode is coming out tomorrow. The one we are about to listen to is today. I'm really excited about these episodes. And by the way, there's no guest. It's just you and I. What can listeners expect to hear?
Oh, it's classroom time with Ryan and David, man. It's going to be great. There's so much information to get out there. And each one of these episodes represents its own opportunity. And people who generally think that, like, public goods, those are the things that you donate to, or those are the people that work towards just, public goods, and there's no upside there because they're public goods. You're wrong. This is where things change, and this is the beautiful mechanism of retroactive public goods funding, where we are injecting Silicon Valley type upside potentials into people that build public goods products. And this is something that has never before seen on the face of this earth or in crypto economics at large. And so if you think that that is just like, oh, Ryan and David talking about public goods, no, we're talking about alpha, and we're going to tell you about how you can get potentially the billions of dollars that are going to be generated from MEV and block-based sales on layer 2s, and how that can go into your pocket when you build something useful for these layer 2s. But that is all in episode number 2, which is coming out tomorrow. Episode number 1, which you are listening to right now, is all about how the Ether economics change in a layer 2 paradigm, as Ryan said. And of course, as we ended this podcast, we talked about perhaps the liquidity mining incentive programs that may or may not be coming for these layer 2s. And of course, as we hit stop on the recording, we just heard that Optimism launched its layer 2 liquidity mining program. So you know these things are coming. They are here today, and we can start building towards getting some of that money into our pockets right now. And that is all about all of these opportunities that layer 2 offers for you, for me, and for the world.
Guys, fantastic episodes coming up for you. If you like these episodes, make sure you like and subscribe. Of course, if you're watching on YouTube, make sure you subscribe to the channel. If you're on the podcast, make sure you're subscribing to this feed. Okay, we're going to get right to the episode. But before we do, we want to thank the sponsors that made this episode possible.
ARBITRUM is an Ethereum layer 2 scaling solution that's going to completely change how we use DeFi and NFTs. Over 300 projects have already deployed to ARBITRUM, and the DeFi and NFT ecosystems are growing rapidly. Some of the coolest and newest NFT collections have chosen ARBITRUM as their home, all the while DeFi protocols continue to see increased usage and liquidity. Using ARBITRUM has never been easier, especially with the ability to deposit directly into ARBITRUM through all the exchanges, including Binance, FTX, Huobi, and Crypto.com. Once inside, you'll notice ARBITRUM increases Ethereum speed by orders of magnitude for a fraction of the cost of the average gas fee. If you're a developer who wants low gas fees and instant transactions for your users, visit arbitrum.io/developer to start building your dApp on ARBITRUM. If you're a degen, many of your favorite dApps on Ethereum are already on ARBITRUM, with many moving over every day. Go to bridge.arbitrum.io now to start bridging over your ETH and other tokens in order to experience DeFi and NFTs in the way it was always meant to be: fast, cheap, secure, and friction-free. The Brave browser is the user-first browser for the Web3 internet, with over 50 million monthly active users. Control your digital footprint with built-in privacy and ad blocking. Inside the Brave browser, you'll find the Brave Wallet, the first secure crypto wallet built natively inside of a Web3 crypto browser. Web3 is freedom from big tech and Wall Street, more control and better privacy. But there's a weak point in Web3, your crypto wallet. The Brave Wallet is different. Brave Wallet is built natively inside the Brave browser, no extension required, which gives the Brave Wallet an extra level of security versus other wallets. With the Brave Wallet, you can buy, store, send, and swap your crypto assets, and you can even manage your NFTs and connect to other wallets and DeFi DeFi apps, all from the security of the best privacy browser on the market. Whether you're new to crypto or a seasoned pro, it's time to switch to the Brave wallet. Download Brave at brave.com/bankless and click the wallet icon to get started. AAVE is the leading decentralized liquidity protocol, and now AAVE v3 is here. AAVE v3 has powerful new features to enable you to get the most out of DeFi, including isolation mode, which allows for many more markets to be launched with more exotic collateral types, and also efficiency mode, which allows for higher loan-to-value ratios, and of course, portals, allowing users to port their AAVE position across all of the networks that AAVE operates on, like Polygon, Phantom, Avalanche, Arbitrum, Optimism, and Harmony. The beautiful thing about AAVE is that it's completely open source, decentralized, and governed by its community, enabling a truly bankless future for us all. To get your first crypto collateralized loan, get started at aave.com. That's AAVE.com. And also check out the AAVE protocol governance forums to see what more than 100,000 DAO members are all raving about at governance.aave.com.
Hey guys, welcome to a classic David and Ryan episode. This is just the two of us. So I think maybe the format is, David, I'm going to be kind of interviewing you and then adding color commentary because this is something that you've wanted to talk about a while. We're talking all about layer 2 and the possibilities in layer 2 at the ETH level, the Ethereum level, at the layer 2 level, and then working on public goods. So, I don't have to introduce you. Guys, this is my co-host, David. How's it going, man?
Good. This is my co-host, Ryan. How are you doing?
I'm doing great. Why are you so excited about layer 2s, David?
Oh, because there's just so much surface area for opportunities, Ryan. Like you listed them off, like the opportunity for Ether, the asset, to become even more money are huge, and so there's things to talk about that with that, like how layer 2s will impact the ETH burn rate, how layer 2s will impact reservation demand for ETH, how layer 2s impact the staking rate of ETH, the APY you can get from staking ETH on the layer 1. And that's just with ETH. There's also bridge opportunities and yield opportunities. There's also the layer 2 token themselves. Each one represents an opportunity in of themselves. There's also the opportunity, Ryan, to spin up many, many layer 2s. And so these things are infinitely forkable and infinitely copy and pasteable. And there's all of these economic things to discuss. And that's even before we get to the secret opportunity that so few people are talking about, which I think is going to put billions of dollars into entrepreneurs' hands over the next 12 months and ultimately become to a $1 trillion industry, which is fighting for what we call retroactive public goods funding, where public goods turns into upside as same level as like a Web 2 Silicon Valley startup exposure, but for building public goods products. I think, Ryan, this is a coming $1 trillion opportunity over the next decade, and we are on the cusp of seeing this ball really get starting to roll. So I want to make sure the Bankless Nation knows what's coming, because there is a lot of opportunity just over the horizon.
If you're playing a Bankless drinking game this episode, please do not use opportunity as your word, because I think I counted like 8 times or something that David just said opportunity. And I think, look, that's the theme of the show, is there's this new white space that has opened up in front of us, this new horizon, which is layer 2. And it has so many opportunities for expansion. It's like crypto is new again, right? Like you missed out on original Bitcoin in 2013. You missed out on Ethereum in 2015, 2016. Well, now layer 2s are open for you. And there's so much that needs to be built out in this ecosystem. So we're going to talk a lot about it. Okay, let's start here with the bull case for ETH, because you and I believe layer 2s are actually bullish for ETH, the asset. Not everyone believes that. In fact, I've been seeing a lot of things on Twitter, a lot of pushback about this, saying layer 2 tokens in particular, and layer 2s themselves, are actually parasitic to Ether, the asset, and to Ethereum, the network. So let's spend some time talking about the opportunity that is ETH in a layer 2 world. But let's start with that question, David. Do you think layer 2s cannibalize Ethereum? Do they cannibalize the layer 1, especially with them launching their own tokens? Are these tokens going to be competitive with Ether as an asset?
I think if we saw layer 2s having their own tokens and those tokens become instantiated as money in those layer 2s, then the argument for do layer 2s cannibalize Ethereum would be a lot stronger. But I do not see that actually shaping up to be the way that layer 2s work. The way that the trajectory seems to be is that layer 2s are probably going to all issue their own tokens. Optimism just announced their token. If you're paying attention to Arbitrum, you kind of know that they're probably headed in that same direction as well. And there are other layer 2s that also have their own tokens, but they all accept Ether as money inside of each one of those ecosystems. And so Ether is the currency inside of Optimism, inside of Arbitrum. And even on Arbitrum, you call it AETH, and on Optimism, you call it Optimism ETH. And this is the native currency of these layer 2 chains. Now, part of the argument for these layer 2s being parasitic for the Ethereum layer 1 is that they sap away transaction demand from the layer 1 and they put it on the layer 2. And so, well, clearly it's parasitic, because if we're taking away transactions from the base chain, which is the chain that pays for security, and we put it on the layer 2s, then that revenue is going to a different spot. And now it's going to revenue for the Optimism token or the Arbitrum token or the ZK Sync token, instead of actually being paid for Ethereum validators. This is true to some degree, but you have to remember that layer 2s are blockchains that also settle on Ethereum itself. So all of the revenue that all of these layer 2s create from selling their blocks, that turns into block-based demand for the Ethereum layer 1. So the way that I explain this to a lot of people is that they are like solar panels for economic activity that plug right into the Ethereum layer 1. So Optimism, Arbitrum, big solar panels, big solar arrays. They get how big these solar panel fields are a function of how cheap their fees are, because the cheaper the fees, the more economic activity they can support. And so by reducing fees on the layer 2s, they actually are inducing more total economic activity that otherwise wouldn't have been available on the Ethereum L1. I mean, Optimism and Arbitrum and layer 2s, they're not pulling away economic activity that requires less than $5 per transaction, because that economic activity simply doesn't exist on the layer 1. They are actually creating that on the layer 2 and acting as an aggregator of economic activity and injecting it into the layer 1. So in some ways, they do borrow from economic activity on the layer 1, but it's stuff that should have been on the layer 2 to begin with, and it always aggregates and puts it back onto the layer 1 at the end of the day.
Yeah, you know what this argument reminds me of is basically, have you seen this? Have you ever seen this map, David? This is a map of the U.S. and the U.S. states in this map. Looking at this on YouTube, if you can see the visual, but we'll try to include a link in the show notes. This is U.S. states renamed for countries with a similar GDP. And if you look at the state of California, it is a similar GDP as the United Kingdom. Texas is similar in size to Canada, the nation state. So one state in the United States is the size of a major G7 country, Canada. Florida is the size of Indonesia. New York State is the size of South Korea. And I think L2s, the argument that L2s are parasitic to Ethereum would be kind of like saying New York, California, Texas, and Florida are parasitic to the US economy. It's like, no, these are part of the US economy, right? It's like not everything has to happen. Not all of the GDP has to be produced at the federal level. In fact, the GDP of the US is the sum of all of the GDP, the economic activity of its states, of its vassal states. And these states, they have different tax codes and they have lots of autonomy, but they still adopt the coinage of the US government, for example. They still receive the defense and security protection of the US military as well. And they are states in a union. And so to me, this is a very useful analog, right? It's like they're all part of the same Ethereum nation, if you will. And Ethereum is kind of a united set of chains after a fashion. You can also see this, David, if you go to the burn leaderboard here, right? These are actual applications paying their taxes. They're consuming Ethereum block space. And right now you see things like ENS and OpenSea at the top. We expect that a lot of these things will move to layer 2s over time. A lot of this economic activity, even when you scroll down a little bit farther, you start to see Arbitrum. How much over the last day did Arbitrum pay in taxes? Oh, 33 ETH. I expect someday this entire burn leaderboard will be full of layer 2s, essentially.
Other blockchains, yeah.
Yeah, the demand is going to, we said this in the past, the demand is moving on Ethereum mainnet from block space demand, that is, from users and to applications. We already seen kind of that transition, and ultimately it's going to land. It's just other chains that are going to be the primary block space consumers. And so all this is additive to the economic, impact, the economic throughput of Ethereum. It's like a union of chains, not completely separate chains. That's a useful analog to me when I think about this.
And I really like the states model, because there is huge benefits from all of these different countries turning into something more interoperable than separate sovereign nations, and being more like states where you can just freely walk across borders from California to Oregon to Washington, or eventually from California and walk all the way to New York. Like, trade can happen across all of these things because they all settle on the same protocol.
And we even have a highway system, right? Interstate highway system.
Exactly. And like, there's no tolls between California and New York. Well, there's probably some, but the point is like, you can drive from California to New York without ever having to prove your citizenship, or you don't have to pay like tariffs or like, trade taxes, because we're all on the same protocol. And so the growth of the Californian GDP has spillover effects to every other state. And so it's pretty crazy when you see the city or the state of Texas being as large as all of Canada, the whole entire mass of land that's above America, but it's as efficient as the smaller mass of land, which is Texas. And like United Kingdom, the former like empire of the world, is equal to just California, just one of 50 states. And so like, this collaboration of layer twos is very much a growing the pie ecosystem that all ultimately comes and settles down to the main Ethereum layer 1. And so it's giving optionality, and it's giving autonomy to every single layer 2 to do what's best for themselves. And layer 2s will therefore have to do what's best for their users, because that's their job. Their job is to aggregate users' economic activity to make it cheap, and then ultimately come and secure that with the main Ethereum layer 1.
Let's talk a little bit more about the economics in this layer 2 world. So what about layer 2 fees? What happens to layer 2 fees? So I can pull up a chart in a second. Layer 2 fees, like Optimism, it's hanging out at about 50 cents, call it, to like 90 cents, somewhere in that range. Arbitrum's the same. Some of the ZK rollups are around 10 to 20 cents. I believe, some of this is from memory. And you compare that to mainnet, and the mainnet transaction might be like $8, $10 or something. So on the order of a 90% to 95% reduction in fees. But will it always be like that, or will L2 fees increase over time?
Yeah, there are reasons why layer 2 fees will go up, and also reasons why layer 2 fees will go down. The near-term impacts of layer 2 fees is definitely down, because we are just at the beginning of layer 2 optimizations. There are things that all of these layer 2 teams can do to make their fees go down that they're responsible for. But then there's also EIPs, like EIP 4484. I think is the right number, some combination of 4s and 8s, where like it reduces the cost of call data on the Ethereum layer 1, which is going to drop layer 2 fees by an order of magnitude. And then there's also sharding. As soon as sharding comes into play, we have layer 2 fees going down by another order of magnitude. And so like, each one of these different subsets, like development on the layer 2s themselves by the layer 2 teams, EIP 4484 for reducing call data costs, and then also adding in sharding, each one of those represents an order of magnitude fee reduction, and can finally get us down to what Vitalik calls the internet of money, with sub 5-cent transaction fees, and probably much lower than that. Now, we can also increase transaction fees by just the normal way that you would do that, which is increasing the demand for block space. So as block space gets consumed and it has more and more demand, as we've seen the Ethereum layer 1, you can see fees go up. And this is why like things like Arbitrum and Optimism have somewhere between like 25-cent to $1 transaction fees, because, well, there's actually a decent amount of demand for these things, as evidenced by how much revenue they're making. We'll get to that later. But there is eventually an equilibrium point there where so many layer 2s that have been able to scale out to their maximum degree attract a lot of economic activity, and that induces a lot of economic activity. So it's not like fees are going to be permanently down only. There will be upwards price pressure for block space demand for the layer 2s, and it will hit some sort of equilibrium. But the beautiful thing about this, Ryan, is that when a layer 2 gets too saturated for particular use cases, we can just make more. We can just have another layer 2. And so if we need a layer 2 with hyper cheap fees, there are different design constructions and different optionalities that layer 2s have to make sure that fees can stay basically as low as the layer 2 teams want. And so the long-term equilibrium of these things is a little bit unknown, but with the amount of ammo that we have in the tool belt to keep pushing down fees on the layer 2 is pretty significant. And so I would be very optimistic to seeing less than 5-cent transaction fees sometimes in 2023, and then also scaling that out to more and more users being able to access more and cheaper fees.
All right, so what we're seeing right now is layer 2 transaction fees that are about 90 to 95% cheaper than layer 1. And we're getting some EIP improvements that will massively reduce those transaction fees yet again, right? You mentioned 2 that are coming. And once these 2 are implemented, we'll probably see like sub 5-cent transaction fees, maybe sub 1-cent transaction fees. But we also anticipate at the same time, because when you create more block space, there's more cheap block space, there's more block space demand. So demand will eventually like catch up, and then fees will increase from there, above 1 cent into the future. So I guess right now we've got fees hovering around where they are for the next few months. In 6 months to 18 months, a massive fee reduction that will carry us over for a very long time until block space demand then catches up with it. So when we talk about the fee differences, is there a difference between, I know there's 2 classes of rollup. Is there a difference between optimistic rollups and ZK rollups with respect to fees?
Yeah, so for the user fees, ZK rollups are always going to be cheaper just by definition of what they are. Those are the faster, cheaper transactions. They're just also harder to build and harder to develop on than optimistic rollups. But the cool thing about this, both rollup design constructions, they amortize fees across users. And so actually, the more users that are using rollups, the more the fees are shared, because the fees are ultimately the cost of making a layer 1 transaction. And so when a layer 1 transaction from Optimism or Arbitrum is shared amongst 10 people versus 10,000 people, the more these rollups are used, the cheaper the fees get. So this is actually really like awesome mechanism and just really good mechanism design, where the more and more these things are used, the cheaper and cheaper the fees get, because the cost is split amongst a wider and wider set of participants. This is more true for ZK rollups than it is for optimistic rollups, because ZK rollups have very high fixed costs, as in the transaction for ZK rollups to put a transaction on the layer 1 is about the same size of data every single time, whereas as economic activity on these layer 2s for optimistic rollups, like Arbitrum and Optimism, as they grow, the actual cost of that layer 1 transaction also does increase, but it increases linearly as usage can grow exponentially. So layer 2 usage of optimistic rollups can grow exponentially, while the L1 transaction cost grows linearly. And so they still can, this is like directionally right, they can still amortize higher and higher transaction quantities across more and more users. And so this is a beautiful thing about layer 2s that you just can't do at the layer 1 level, which is as adoption grows, the fees actually go down rather than up.
So we've got layer 2 fees going down over time, at least until such a time that massive block space demand catches up with it. But what about layer 1 fees? What about Ethereum mainnet layer fees? Are we ever going down there?
Probably not, I would say, just because like the opportunity to spin up a new blockchain and then have that be the aggregator of fees down to the layer 1, there's so much potential of DeFi, of crypto left to make newer and newer use cases for what we can do in the crypto world that is going to be unlocked with layer 2s, that it's ultimately going to aggregate a bunch of new economic activity and then put that down onto the layer 1. And that is going to increase block space on the layer 1. And so even if like users stopped, or even if like layer 2s stopped using L1 block space, like even users would start going back to the layer 1, but that's just never going to happen. There's always going to be some sort of just like basal level of demand for Ethereum layer 1 block space. And that basal level of demand is only going to increase as more and more layer 2s come online, and as they themselves create higher and higher block space demand on the layer 1. And so
we've talked about this concept, David, of even Bitcoin in the early days, economic density, right? Mm-hmm. So what we've done is we've compressed far more value, far more economic activity into onto each dollar spent on Ethereum mainnet fees, because now it's not just me buying something on Uniswap as an individual user. You know, that block space fee is the sum of, you know, maybe thousands of transactions on a set of layer twos that then collapse down to a spend on Ethereum. And that's been the trajectory of all successful fees, like more and more economic density of the transactions. You remember in the early days when Eric Voorhees was telling us about his Satoshi Dice, right? Where he's actually using Bitcoin block space for like, what was it? Almost like an early
it's a fun
app.
gambling app that used on-chain like gambling metrics.
And it used in an incredibly, like a lot of Bitcoin block space in an incredibly inefficient way. And very soon it became impractical. This is like the early days of Bitcoin. 2012, 2013 time, it became impractical to actually run Satoshi Dice on Bitcoin. Why? Because other more valuable transactions crowded Satoshi Dice out. And that's exactly what's going to happen with Ethereum mainnet. This is why I agree with you, David. I don't think mainnet transaction fees, like they'll ebb and flow a little bit, but they're never really going to go down in the future. Right. And so that's actually a good thing though, overall, because we want high transaction fees on Ethereum mainnet, in order to prop up the defense budget, the security budget for the Ethereum network and all of the United States, the United chains of Ethereum. So that's actually a very important feature and function. Now, where people get stuck though, is they still think that the Ethereum mainnet is going to be home for users in the future, like individuals paying $30, $40, $100 transaction fees on Ethereum mainnet. What would you say about that?
Right. So if you're a user trying to use the Ethereum layer 1, think about who you are competing against. Like right now, you're competing against other Ethereum whales who have like a ton of Ether and are insensitive to gas prices. And you're also competing against other blockchains, right? And that is the long-term competition for Ethereum layer 1 block space. Do you think that you have enough ammo to compete with other blockchains to consume Ethereum block space? Like the answer is no.
Yeah, I'm gonna say no on that. You're competing with an entire like state level economy. It's like competing with the state of California to get your transaction through.
Right. It doesn't matter how big of a whale you are. Eventually, you will get pushed out to the layer 2s. Like the tide will always go up and up and up, just because because layer 2s are just instantly cash flow positive because any block space demand for the layer 2s turns into block space demand for the layer 1. So all layer 2s have to do is have any ounce of utility around them, and they start being pretty competitive with consuming layer 1 block space. And so like it doesn't matter how big your bags are, like you're going on to layer 2s eventually, no matter what, because that tide will catch up to you.
Yeah, so just don't go there kicking and screaming. I mean, I think some of the message we're talking about in this episode is start to seriously investigate building a home in one of these layer 2s. Like go drive your car through the neighborhood, see if it has nice schools, nice houses, see if it's kind of a vibe that you like, because sooner or later, and I think it should probably be sooner, you should think about migrating all of your activity to these layer 2s. And we've got a lot of contenders to pick from, right? You know, Optimism, ZK. And the nice thing is it's not like just like a neighborhood, because you can live in multiple locations at once. But the location you're probably not going to want to live in, you're going to be priced out of, is the Manhattan, which is essentially Ethereum mainnet. It's too crowded, too busy, too expensive, block space prices going up. So some of the message of this episode is start to investigate some of these layer 2s, because you're going to have to migrate. So may as well start right now.
One thing that has really been a big advantage for the early Ethereum users is having a big footprint on the Ethereum layer 1. Like if you use Uniswap in 2019, you got the airdrop. If you use DYDX, you got the airdrop. And so like now is the time to start growing your footprint on layer 2s. Like just grow, cast your net, do the things, because crypto pays you to learn it. You don't know how or when or how it's coming, but the sooner you establish your settlement on a layer 2 and start just going and doing normal layer 2 things, living your layer 2 life, the larger your footprint will be and the more surface area you'll have for airdrops or just other generalized opportunities.
Totally. And given what we just said, right now, some of these layer 2s, like even $1 on Optimism or ARBITRUM, that's a little expensive for transactions. But realize it's going to get significantly cheaper in the future. Like we're talking 6 months, 12 months, 18 months from now, once some of these Ethereum improvement proposals go through. So you have that to look forward to as well. But let's talk a little bit about the layer 2 paradigm that we're entering and the impact to Ether, the asset. Of course, we talk a lot about Ether, the asset, as an ultrasound money, for instance, as a reserve currency for this thing we're calling the Ethereum economy. But how do layer 2s directly impact the value of Ether, the asset? Again, some have called it parasitic. I think we've made the case for why it's not, but walk us through. Why is it not parasitic for Ether, the asset?
Right, and let's begin by recapping the 3 pillars of ETH value capture, the 3 points on the triple point asset. You have Ether consumption via ETH burning via L1 block fees. Then you also have the stake rate, as in how much yield in ETH terms, how much APY you can get from staking your Ether. And then how much Ether it has, the reservation demand for Ether, like how much collateral can it be on these layer 2s? How much money can it be on these layer 2s? So these are the 3 things that really define Ether as an asset. Locked in DeFi or / locked in layer 2s, the burn rate, how much Ether is getting burned, and then the stake rate. And so the layer 2 paradigm impacts all of these things. And it really always boils down towards how layer 2s are solar panels for economic activity. And so let's start with the ETH burn rate. When layer 2s like have a bunch of economic activity on them, maybe it's like gaming on Immutable or DeFi on Optimism or Arbitrum or any other possible design considerations for any other layer 2s, of which there are many of. All of these scale out the possible economic use cases of Ethereum from where it is today at like a $5 to $50 transaction fee average, and it also goes up from there. But then it lowers that threshold down to 5 cents or below. So this sheer amount of economic activity that can come to ultimately be settled on Ethereum always turns into block space demand for the layer 2s. And so all these layer 2s, which are collecting all of this economic energy from the world around it, come and start burning Ether. And they start burning Ether a lot. Ryan, you earlier showed the ETH burn rate on the ultrasound.money website.
I'm going to show that again.
Yeah, so right now Arbitrum is doing 20 or 33 Ether per day, and Optimism is somewhere just below that as well. Like, we are just in the early days of layer 2s and burning Ether. And this is before Arbitrum even has a token, and before Optimism's token even goes live, and before liquidity mining incentives. And so we'll get to all of those things because those are all relevant.
Just camp on burning for a minute. So for people who maybe they're not quite sure what the linkage between burning Ether is and actually the value of Ether as an asset. So when you say burning, what do you mean? Can you talk about ETH as a deflationary asset and who ultimately gets the benefit from this burnt Ether?
Certainly, yeah. So EIP 1559, it's the famous EIP that changed how block transactions work on Ethereum. About 70% of all blockchain L1 fees on Ethereum gets burnt. And the reason why it gets burnt is multifaceted, but it's basically when Ethereum generates transaction fees, high transaction fees, we don't actually have to give it to the miners, or we don't actually have to give it to the stakers because of how secure Ethereum is anyways, especially under a proof of stake paradigm. And so we're taking in all of this extra revenue, and previously we were just spitting it out to miners and they were just selling it on the open market. And with EIP 1559, it takes in about 70% of all transaction revenue, and that number varies, but 70 seems to be the equilibrium, and it burns it. And so this is the excess of the Ethereum economy. This is the people are spending more than what is needed for Ethereum to secure itself. And so it takes that excess revenue and it just burns it. Because it's extra. We don't actually need to send it back into the economy. And because sending it back into the economy implies some point at which it goes back into the economy, we don't really want to bestow some privileged position in the Ethereum economy as in either the stakers or the miners or anyone. It needs to be credibly neutral. And so what's the most credibly neutral thing to do? We just burn it. And what that does is it's basically a buyback on ETH. So if you own ETH, you are basically being paid this revenue because just by owning the thing. And so instead of injecting it into one specific part of the Ethereum economy, saying like, hey, the miners should get this, or the validators should get this, or Vitalik should get this, instead, the Ethereum economy says, well, if we burn it, we can give it to everyone.
It's like basic income for everybody.
Yes.
Everybody, if you hold ETH,
right,
you get your dividend.
Exactly.
Freedom dividend.
Freedom dividend. Except the best part is you don't actually it doesn't actually go into your wallet. It doesn't actually have to make a transaction on Ethereum. Yeah. Your Ether is just more valuable implicitly because the other Ether has been burnt.
There's less out there.
So this is why we call Ether ultrasound money, because as we go into the merge, you can see if you hit that simulate merge button, which I think maybe you already did, Ryan.
Yeah, I did.
Negative 4% per year, as in Ether is deflating at 4% per year. Do you know, Ryan, how much gold is inflating?
I know base numbers. I don't know the exact numbers, but I'm going to say it depends, right? Because the more valuable the gold, the more inducement there is to inject more supply and to mine more. But I'm going to say 1 to 3% per year. Is that about right?
Yeah, it does vary over time, but the 1.5% is the average metric. So gold, the non-sovereign solar value asset, inflationary at 1.5%. Ether, with today's numbers in the merge, is negative 4%. Bitcoin inflates at 0% over the long term. Ether currently with today's standards inflating at negative 4%. So
when you say Bitcoin is 0% over the long term, I kind of understand that, but that's also a little bit of Bitcoiner speak. Practically, right, yeah. What we're getting in the market is about a 1.5 issuance rate for Bitcoin, something to that effect until the next halving, and then that gets cut in half again. But yeah, so this 4% per year, that's based on the 7-day burn rate. And you tweak the numbers because any 7-day period of time, there'll be a different burn rate. So if you pull that back to 30 days, it's a little less. It's a negative 1.7% burn rate. But we're talking about some pretty big numbers. If you, we haven't even been in a year. It's been about 9 months, I guess, August, since EIP, August 2021, since EIP 1559 went live. We roughly burnt 2% of all ETH supply. It's about 2%, okay? 2.2 million in ETH supply has been burnt in this 9-month period of time. So we're talking about some pretty massive numbers. And what you're saying here is the link between layer 2 and this burn rate is layer 2s are going to burn by far the most amount of block space because we expect them to be the largest consumers of block space. They don't even show on the charts today, guys. Right. That's how early they're not in the top 10. They're not in the top 15. You have to look to the top 20 to start to see ARBITRUM. But that's all going to change is what we're predicting. And they're going to be some of the top burners. And all of that burn goes back as a dividend to anyone who holds ETH. You don't have to stake. You don't have to validate. You just have to own some ETH in the Ethereum economy, and you get the proceeds of all of the layer 2s. So what you're saying is just in that first pillar, layer 2s are good for ETH, the asset.
Yes, right. Ryan, do you remember when I say DeFi summer, what gas fee numbers come to mind? What was the sustained gas fee numbers?
I just feel like I saw a lot in the 300s. I felt it was a lot in the 300s. Maybe that's just whenever I looked, it was at least there. What number did you have in mind?
Yeah, 200 to 300. It was at over 200 to 300 for at least a couple months in a row, and that was the on-chain bull market for Ethereum. The average gas fee over the last 7 days right now is 45, and it's been that way for the last 2 months or so. And this is because DeFi summer, a lot of on-chain activity is a huge bull market, huge mania, but it sustained 200 to 300 GWE for months, and so that would put us at a negative 7, 8, 9% deflationary rate. And so when I use the metaphor that layer 2s are solar panels and they are collecting energy to burn ether, that is going into burning ether at the layer 1. These are solar panels for economic energy, and that ultimately comes to the throwing ether into the furnace over time.
And why is that a good thing? We'll just make one link and then we'll go to the next to the next pillar that you're talking about. The reason that's a good thing is because burning ether is a public good. Why? Yes. Because the more valuable ether is, the greater security the Ethereum network has, and the greater security for all of the united chains of Ethereum, all of the other layer 2s. So an L2 burning ETH on Ethereum makes ether more valuable and increases the security budget for the entire Ethereum network. So it's California, Texas, Florida, they're all paying their taxes to the federal government, and the federal government can then spend more on national security. And of course, These states can secede at any time, of course. Their chains, it's a completely opt-in network. So it's not as if Ethereum is like forcing these chains to become rollups and become layer twos. They're doing that of their own accord, but that's how you get a self-reinforcing economy.
And the beauty of this, Ryan, is that when there is a lot of Ether burn, that again, burning the excess revenue for the Ethereum protocol, it also means that Ethereum doesn't have to issue as much new Ether, because if Ether increases in price, that means we are getting more bang for our buck when we issue and mint one new Ether to pay for security. If that Ether is more highly priced, we get more value per unit. And so as the Ethereum revenue protocol collects all the revenue from burning Ether, it means we don't have to issue as much. And so this turns into a positive feedback loop of value accrual. Because we are burning so much, the price is going up, the value of it is going up, and so therefore issuing more Ether, it requires less issuance, and so which furthers how scarce it is. So it's this great positive feedback loop of security.
And then the higher security you get, the more layer twos you attract, because more people want to be associated with Ethereum because they want that security to underlie their chain as well. The ETH stake rate, does that actually have any impact in layer twos? That was the second pillar you said of the 3 pillars of Ether, value proposition. Does the stake rate change at all?
The ETH stake rate is a complicated beast, especially in a layer 2 world. Right now, like I said earlier, 70% of Ether block space transaction fees go into burning Ether, implying that 30% goes to the ETH stake rate. That probably changes over time in a layer 2 environment, and it's one of those things where we're just going to need more data for. What we do know is that if you believe that Ether will go up in price because more and more Ether gets burnt, and it's also becoming more and more money in all these layer 2s, that the dollar denominated APY is also going up bigly. The Ether denominated APY is a harder thing to reason about. There's a lot of debate out there as to where MEV gets captured. Is MEV, and that means miner extractable value, as in if you are an Ether validator, when it's your turn to propose a block, you get to order transactions as you see fit, and there is a specific ordering of transactions that you can make that puts more money in your pocket, and so validators compete on how much MEV that they can extract from the blocks. In a world where a lot of economic activity is going to layer 2s, and layer 2s just bundle up a lot of transactions and put them down on the layer 1s, that implies that a lot of MEV ultimately goes onto the layer 2s. And this is actually a conversation that we'll be having later in the show as to what layer 2s do with all this MEV. Naturally, some MEV will work its way down to the layer 1. How much that happens is to be determined. There's definitely going to be arbitrage opportunities as like Optimism settles all of its Uniswap trades onto the layer 1, and then there's an arbitrage opportunity there with Optimism's version of Uniswap with the layer 1 version of Uniswap versus Arbitrum's layer of Uniswap. That is all arbitrage opportunity, and that creates MEV at the base layer. The proportion of this is to be determined. There's a lot of data that we need to really look at, but I think the main thing to take away is that perhaps in Ether terms, Ether denominated terms, staking APY is about the same, but in dollar terms, because of how bullish layer 2s are for Ether, the asset, in dollar terms goes up bigly.
So we got the burn rate, which positively impacts like the value of Ether, very likely. The ETH stake rate that is probably neutral. Maybe some good, maybe bad. We'll call that we'll call that even, call it neutral. And then the last piece is the demand for ETH. So what is the impact of layer 2s on the demand for Ether, the asset?
Well, very simplistically, layer 2s need Ether to make layer 1 transactions. So the protocols themselves have to have a supply of Ether in order to run the actual layer 2. And so each protocol generates its own renovation demand, but that's probably orders of magnitude smaller than the total reservation demand. Reservation demand is just a term that people use when there's these entities that demand to hold some currency. And so layer 2s have their own native demand for Ether. MakerDAO, for example, has reservation demand for Ether with how much Ether are in MakerDAO vaults. And you can imagine as we unlock new use cases for crypto on these layer 2s that have super cheap fees, we can create new protocols that induce their own reservation demand for Ether, the most trustless asset on Ethereum. And so as we come up with new use cases, as we come up with new DeFi apps, and as people take their Ether off of the layer 1 and put it on the layer 2, just the reasons why people can want to hold Ether just goes up. And so there's always this frustration about like, I can't do anything on the Ethereum layer 1 because of the fees. Well, as soon as we solve that problem on the layer 2s, we unlock a lot of reasons to deposit Ether into the layer 2 for this reason or that reason. And so it just creates more surface area for Ether demand for different use cases that we haven't been able to unlock for.
Yeah, so layer 2s, the first thing you said is layer 2s have to have some Ether in order to pay their taxes, because their taxes are due denominated in ETH, because basically they need to buy block space from Ethereum, and they have to pay for that block space in ETH. So that's one source. The other source that you're saying is all of these like applications on the layer 2s themselves inside of these layer 2 economies. And I think you could start to see that. These are some stats from bridges. There's a bridge to Arbitrum, a bridge to Optimism. There's already, David, on Arbitrum alone at this early stage in the game, like pre-Arbitrum token, there's $1.3 billion worth of ETH on Arbitrum. It's been bridged to Arbitrum.
That's a lot.
That's about like, it's almost getting close to it's a 0.25% of all ETH supply, okay? Getting close to half locked up in the Arbitrum economy. Optimism, 148 million. I bet that will swell in value too. These are only 2 of the layer 2 networks. We could look at all of the others, right? And even it's funny, alternative layer 1s and side chains also have a lot of ETH demand. You can see that in the bridge stats as well. So Ether as an asset in these layer 2 economies as like a primary monetary asset is that's going to be a source of demand, a very like inductive source of demand as well. And it'll form a lot of the basic total locked value inside of these ecosystems too. So that's a demand case right there. Anything else you want to say? I mean, overall, like pretty bullish. We're going to burn more ETH. Staking rates are going to be about the same, maybe positively impacted, maybe a little negatively, but we call it a wash the same. But the demand for Ether as an asset is going to be massive in all of these layer 2 economies. And if they are successful, which we think they will be, and these economies in layer 2 grow, that will just massively increase the amount of demand for a monetary asset like Ether inside of their economies.
Just to add on to the bridge aspect of things, bridges demand Ether because you have to hop from Arbitrum to Optimism to the L1, and so they need to hold Ether. But then they also need to hold stablecoins. And so there's also going to be stablecoin demand by these bridges and these layer 2s. And one of our friends, Jim Bianco, he's always expressed bullishness as to if we want the next leg up in crypto prices, it needs to come from on-chain stablecoin liquidity. So stablecoin supply needs to go up in order for DeFi to really have its next moment. And when we have these yields coming from all of these bridge mechanisms where you can get onto Optimism or Arbitrum instantaneously, but getting off takes 7 days. And so there these bridges like Connext, like Hop, like Li-Fi that have all of these deposits into their bridges that allow people to hop in and out of these layer 2s instantaneously. And so they also create a lot of stablecoin demand and stablecoin liquidity, some in the form of USDC, of course, but also some in the form of DAI and other decentralized stablecoins. And those stablecoins ultimately have Ether as reservation demand somewhere else. And so as stablecoin supply goes up because of the liquidity needed for bridges and also other generalized DeFi use cases, the demand for Ether goes up because these decentralized stablecoins like Frax and DAI use Ether as collateral behind them. And so this is just one example of like the immense amount of surface area that comes with layer 2s that will ultimately settle back down to needing Ether in people's pockets.
So guys, if you're playing your drinking game, you're looking for opportunity number 1. All right, we just said it. Opportunity number 1 is Ether the asset. Okay, the fundamentals.
It always is. It always is.
Like the economics for Ether the asset in an L2 world could not be stronger. I just don't even understand why people think that L2s are going to be negative for the price of ETH. It makes absolutely no sense to me. At least on any long-term scale. There might be some attention premium that L2 tokens get in like the short run, right? Really excited about Optimism token, Arbitrum token, whatever other layer 2 token, and we're going to sell our ETH for these things. That might happen in the short term, but you could see the gravitational pull and force of Ether as an asset. The fundamentals are only going to get stronger.
All right, guys, that was all about Ether in a layer 2 world. And the economics of layer twos as a result with fees. In the second half of the show, there's also the narrative trade. We know that crypto runs on narratives. We know that crypto runs on attention. What happens when we start doing liquidity mining and token incentives with these layer two tokens? What happens when the same growth that happened with the liquidity mining for alt layer ones starts to happen to layer twos? Is that going to create just the layer two season? Is that the layer two narrative game that is coming up? There's plenty of evidence to suggest that layer two season is around the corner. It's easier to spin up layer twos than it is to layer ones. And so that will create just a Cambrian explosion of layer twos. That's the thesis. So we're going to get to that part of the show right after we get to some of these fantastic sponsors that make this show possible. If you're trying to grow and preserve your crypto wealth, optimizing your taxes is just as lucrative as trying to find the next hidden gem. ALTO IRA can help you invest in crypto in tax-advantaged ways to help you preserve your hard-earned money. ALTO Crypto IRA lets you invest in more than 150 coins and tokens with all the same tax advantages of an IRA. They make it easy to fund your alternative IRA or crypto IRA via your 401k or by contributing directly from your bank account. There is no setup or account fees, and it's all you need to do to invest in crypto tax-free. Let me repeat that again. You can invest in crypto tax-free. Diversify like the pros and trade without tax headaches. Open an ALTO Crypto IRA to invest in crypto tax-free. Just go to altoira.com/bankless. That's ALTOIRA.com/bankless and start investing in crypto today. The Layer 2 era is upon us. Ethereum's Layer 2 ecosystem is growing every day, and we need bridges to be fast and efficient in order to live a Layer 2 life. Across is the fastest, cheapest, and most secure cross-chain bridge. With Across, you don't have to worry about the long wait times or high fees to get your assets to the chain of your choice. Assets are bridged and available for use almost instantaneously. Across bridges are powered by UMA's optimistic oracle to securely transfer tokens from Layer 2 back to Ethereum. A token proposal is being deliberated as we speak in the Across forum, where community members will decide on the token distribution. You can have your part of Across's story by joining the Discord and becoming a co-founder and helping to design the fair launch of Across. If you want to bridge your assets quickly and securely, go to across.to to bridge your assets between Ethereum, Optimism, Arbitrum, or Boba networks. MakerDAO is the OG DeFi protocol. The MakerDAO produces DAI, the industry's most battle-tested and resilient stablecoin. Using Maker, you don't need to sell your collateral if you need liquidity. Instead, you can spin up a Maker vault and use your collateral to mint DAI directly. With Maker, the power to mint new money is in your hands. The Maker protocol is extremely hardened and operated by one of the most experienced DAOs in existence. They've been here since the beginning, they've seen it all, and so you can mint DAI with the assurance that your collateral is safe. Soon, Maker will be present on all chains and L2s, so minting DAI can take place on Oasis.app, Zerion, Zapper, or any other DeFi protocol that you use. Follow Maker on Twitter @MakerDAO and learn from the oldest and most resilient DAO in existence.
Let's talk a little bit about maybe the second opportunity, right? If those are the fundamentals for this network, there's also, I feel like, a narrative opportunity, right? And so we talk about so much on Bankless, like decide which type of investor you are. Are you a fundamentals investor? Are you a narrative investor? Are you a trader? And Bankless always skews more towards the fundamentals, definitely not on the trading side. But there's also some narrative plays that are kind of fun. And I think Layer 2 season is going to be a narrative. David, can you make the case for Layer 2 season? Is this going to be like the Alt 1 layer, like the Alt 1 explosion that we saw previous summer in summer 2021?
Ryan, I can certainly make the case for Layer 2 season.
I knew you'd come through.
So the first thing that I'd say is that it is trivially easy to spin up a new Layer 2 in contrast with a brand new entire blockchain. And that's because of how Layer 2s already have a very difficult problem already solved for them out of the box, which is blockchain security. You do not need to secure your Layer 2 if you just settle down into the Ethereum Layer 1. Ethereum, the security components of Ethereum, which it's highly optimized for, and it's the most secure blockchain in the world, you can just borrow from Ethereum security while you create your Layer 2. That's the whole point of a Layer 2, is that you can have scale without sacrificing security. And so by reducing the barriers to spinning up a Layer 2, you are naturally going to induce more and more Layer 2s to work, to be spun up. And we saw how many Layer 1s got spun up in 2021. Avalanche, Solana, Phantom, Definity, all of these layer ones, and some of them got started in 2020, but they really hit their moment in 2021. And all of this came from the demand for block space that the Ethereum layer one couldn't satisfy. And so all these layer ones got spun up. But that's hard mode. Like spinning up a whole entire new blockchain is hard mode. Where in contrast, spinning up a layer two, you can actually just fork Optimism. You can just fork Arbitrum. Their code is available to you. And so spinning up a layer two is trivially easy. And the best part about this is that as soon as your layer two has any ounce of demand for the block space, it becomes cash flow positive, which is something that all the alternative layer ones are so far away from.
Okay, so why? Why is it cash flow positive? I think this is a really important point. The economics of layer twos are just too good. Why?
Right. Yeah, because they don't have to pay for security, Ryan.
Oh, okay.
Right. So like, does Oregon have its own military? Like it has its police force, it's got that, but like no, it just outsources all of its military to the United States, which is a way better military. Like the budget for the U.S. military.
Hey, don't knock Oregon, David. I'm sure they can muster something.
Yeah, they got something, right? But like the United States military has like stealth bombers that we don't even know about, and this is the same metaphor for layer twos, where no, you don't need to fund your own security mechanisms. You don't need to pay for security. There is no issuance of the Optimism token every time a new Optimism block is produced. And the reason for this is because they just settled their blocks onto Ethereum, and all of a sudden the defense of Ether in proof of stake Ethereum becomes the defense force for Optimism. So there is no there's no security budget for Optimism because it hooks into the Ethereum layer one. The Ethereum layer one pays security on Optimism's behalf, on Arbitrum's behalf. And so that creates, like, there's no net new issuance. There's no inflation in the actual token as a result of security. That is a problem that every single other layer one blockchain has to contend with. Solana is inflating at 9%. Avalanche is inflating at 5.5%. Other layer ones are inflating above 10%. Ethereum layer twos, they inflate at a rate that is chosen by them just for basic incentives. I think Optimism is inflating at 2%, but they opted into that. They actually can turn that off at any moment.
Yeah, and that 2% goes to what we'll talk about later. Public goods. It goes to the actual improvement of the Optimism ecosystem and all of the other Ethereum layer twos. Just to put some numbers on this, I know we've talked about this before on various podcasts, but just, it's worth repeating. Okay. This is the security budget that chains are actually paying. It's a number that, like, I don't know why more people don't talk about. Bitcoin pays $36 million per day in security, in the form of block rewards, issuance, new Bitcoin being issued to its defense force, which is Bitcoin miners. Ethereum pays $37 million in security issued in ETH. By the way, post-merge, that's going to drop all the way down, right?
0.4%, an order of magnitude.
And so that's going to drop from 4.13% to probably around 1%. And then when you subtract the burn, that's where you get into deflationary ultrasound money territory, where we got negative 2% issuance or something like this. Solana pays $8.5 million per day, almost as much as Ethereum, like a quarter of Ethereum's defense budget, okay? Avalanche pays $3.7 million, okay? So they're all paying a lot for security. And this is the amount of revenue that they're generating for that security. Ethereum is almost generating so it paid, it pays $37 million, at least in these figures, and then it made $46 million in block space sales. So it's actually net positive, which is one of the few times in history I've actually seen Ethereum or any chain be net positive. Number 2. Yeah. And so net positive. But look if you scroll down to, I gotta find it, Solana. $46,000 per day
of revenue.
So it's spending $8 million. Listen to this, guys. It's spending $8 million per day, and it's making in terms of tax revenue, tax cost, $8.6 million, tax revenue, $46,000. Okay, there's a deficit
company,
there.
Ryan.
There's a deficit there, right? Bearish government. Would you buy those bonds? Because that's what you're buying with the SOL token. You're effectively buying bonds that secure that. So And now, supporters of all of these Alt1 ecosystems will say, well, these transaction fees, this block space demand will increase over time. I'm like, yes, okay, maybe. And if they do, they'll no longer be cheap.
Right.
All right. So where's your competitive advantage? Avalanche paying $600,000 per day, right? So also, or actually making $600,000 per day. So also at a deficit. Although I have seen, to be fair to Avalanche, I have seen them start to produce more and more block space sales. So that is a good sign for the Avalanche network. It's still nowhere where it needs to be in order to be net positive. But okay, all that aside, what you actually said, what David actually said here, guys, is layer 2s don't have to pay any issuance. All right?
It's free. It comes free.
They're Oregon. Okay?
Yeah.
They're not they're not paying for their own military. Right. It's like a small percentage based on what they use. It's like a usage tax. Excise tax is paid to the Ethereum network in terms of block space sales. No issuance fee. So none of these layer 2 tokens actually have to create more supply of their token to the market. So they have ultrasound money assets, if you will, like deflationary assets, if you will, if they want to, from day one, effectively. And what we're saying is that is a killer economic advantage.
Right. And this is what you get when you align with the Ethereum protocol. When your protocol decides to use Ethereum for security, you don't have any costs because Ethereum just protects you on its behalf, and all you have to do is pay the small taxes to the Ethereum L1 that enables it to secure your transactions in the first place. So 100% pure revenue. As soon as you can create any sort of demand for your block space on the layer 2, you're in the green. You're in the green. And so, Ryan, we saw a lot of these alt layer 1 ecosystems really get bootstrapped by VC funding. What do you think happens when the Optimism token starts trading in a few weeks and then the Arbitrum token comes out and you're seeing $5 billion market cap plus? That's going to generate a ton of incentive for the same sort of thing to be created around layer 2s. Except, again, it's just the economics are going to be much more sustainable. And so there is, what I think is happening is on the horizon, there is just this insane layer 2 mania when so many people wrap their heads around how easy it is to create a layer 2, how instantly cash flow positive it is, and how much surface area there is to spin up new ones. I think we're on the cusp of what we're always been calling layer 2 summer. We just don't know which summer.
Well, let me show you guys a graph. So the thing we've been missing, I think, is layer 2s that have been able to actually sustain this traffic and volume. And the layer 2s like Optimism and Arbitrum, up to this point, and even now they've still had their governors on. They've been in this very slow rollout phase, right? But the big thing we've been missing is once those governors are removed is tokens. And this is Avalanche, if you recall, last summer what they did is they launched an incentive program for DeFi to essentially giving people AVAX tokens in order to use DeFi on Avalanche. I want to show you this graph.
You can't see the date, but the date is August 18th. It's hidden.
August 18th.
August 18th.
There you go.
August 18th, 2021.
See if you can spot on this chart, David. Where's August 18th on this chart? Avalanche total locked value.
Oh, it's let's see. It's right there where the line is, Ryan, where it just starts going up and to the right. The TVL on Avalanche just is nothing, and then August 18th it starts going up and to the right. And so Avalanche went from 13 million in TVL on August 18th to just a few months later, it was $13 billion before the end of the year.
And so TVL, of course, stands for total locked value. So it's the amount of assets on the Avalanche network, right?
Mm-hmm, totally. And so you saw multiple orders of magnitude going from 300 million to 13 billion in 4 or 5 months as soon as there was any sort of Avalanche liquidity mining in program. Granted, again, there was a lot of pent up demand for this block space. And so Avalanche was at the right time at the right place. And so there was a lot of demand for Avalanche block space in of itself. They just needed something to get them kickstarted. During that same time frame without any growth, Arbitrum went from 30 million to 2.5 billion in the same time frame. So well done, Arbitrum. In that same time frame without any liquidity incentives, it went from $30 million to 2.5 billion in that same time frame. And now it's at 3.4 billion before any liquidity mining incentives. Optimism went from 70 million to 400 million in that same time frame, again, without any liquidity incentives. So what happens when these liquidity incentives turn on and there is a direct, secure, economic, cryptographic bridge to the Ethereum layer 1? So porting your money over to Optimism or Arbitrum is so trivially easy versus having to spin up a whole entire new blockchain. So there's this massive economy just waiting for these incentives. And now with Optimism's token getting launched, they haven't launched any liquidity mining details, but maybe they will. Arbitrum perhaps the same. As soon as this kicks into gear, like, you're going to see just an absolute migration onto layer 2s, which is why we are saying go check out the houses, go check out the roads, check out the schools, go see what you like, but get ahead of the crowd, because as soon as the crowd moves, like, you want to have that real estate before the crowd moves there.
Yeah, and I think what's crazy, David, is if you look at all of the united chains of Ethereum, we get to a figure that's about $6 billion, and that's pre-token incentive. And so what we're saying here is there's not only a fundamentals play, but there's also a narrative play. As soon as these layer 2s start to issue tokens, they're already competitive with alternative layer 1s. When you compare, total value locked, and you compare like the amount of revenue that they're actually generating, like the amount of revenue that Arbitrum is generating, it's generating like double the amount of Solana. And so is Optimism in terms of block space sales revenue. Okay, it's already generating double. What's the thing it's missing? Tokens, token incentive, narrative, like these things that for some reason haven't quite caught up to the fundamentals yet. But that's the case. That's what we think is coming. And I don't know, David, if you want to put any timeline predictions on this of like when it's going to happen. Like, it's really hard to say whether this is going to happen in June, in July, like what other factors are at play. But what we're seeing here is just all of this raw kindling, this tinder, that all it takes is some ignition, maybe some influencer, maybe 3 Hours Capital, like apes into a token or something like that, and sets off this frenzy. And then you have the narrative in full effect, and you have L2 season has begun, basically.
I will say there is going to be one big difference between the liquidity mining incentives of other chains versus what Arbitrum and Optimism is doing. Liquidity mining is a short-term game. You are basically paying for people's attention. You're paying for their TVL. And so eventually that runs out. It's a great way to get attention. It's a great way to get mind share on your application, because like when you pay, like, I don't know, $5, $10, $50 million a day in liquidity mining incentives, like, you're going to get attention and people are going to fight for that. Like, famously, Optimism is a very long-term thinking organization, and same with Arbitrum as well. And so they are very cognizant of how liquidity mining is a short-term game. So they might not be as aggressive with their liquidity mining incentives as other alt layer 1s were, because they are thinking for the longest term possible. So there is a cultural difference, I think, between these layer 2 teams versus these layer 1 teams that are a difference that is going to create a difference in my mind with alt layer 1 summer of 2021 versus the coming layer 2 summer. But we do know that they have tokens that they need to distribute in a fair and equitable and decentralized manner. And as users, you can compete and fight for those tokens if you want them, and you can get your hands on them if you do the things that the protocols want you to do, which are to be determined.
So Optimism and Arbitrum, maybe they are longer term thinking, but here's what's going to happen, right? We're going to have a whole bunch of alt layer 2s, and these will be forks of Optimism and Arbitrum, and any of the ZK rollup chains that can be forked will be forked.
Certainly.
And more short term thinking project founders will spin these things up, and some would argue already have to some extent, are already creeping down that lane, and then we'll still see a frenzy, right? It's like, as soon as the narrative takes hold, I expect a whole lot of frenzy. Maybe not from the OGs, but certainly from the new crowd who wants to capitalize on this narrative. That's what we've seen with everything in crypto in the past. All right, guys, so that was the bull case. Those are 2 opportunities for you in the L2 world, the L2 paradigm. David, I think we should just summarize this, and then we should get to a part 2 episode, because we're going a little bit long here, and I think this is going to require 2 parts to get everything we want said. So give us the summary of what we talked about, and let's give a precursor to what we're going to cover in the next episode in part 2 and when that's coming out.
Yeah. Just running through it again. Layer 2s, they will borrow some economic activity from the layer 1s and they will put it on the layer 2s, but they will in aggregate create way newer, brand new use cases, brand new economic activity on the layer 2s, which will ultimately come down to settle on the Ethereum layer 1s. Layer 1's block space will be consumed primarily by these blockchains, and Ethereum will over time become a blockchain that settles the blocks of other blockchains. And so layer 1 fees are up only. Meanwhile, we have so many paths forward for layer 2s to reduce their layer 2 fees. There's optimizations at the layer 2 level, innovations at the layer 2 protocols themselves. There's Ethereum EIPs like 4488 and also dank sharding as well. And so layer 2 fees are down only while layer 1 fees are up only. This increases the ETH burn rate. This increases how ultrasound the ultrasound money actually is. Bridges, the cross-chain bridges will create reservation demand. They will create yield opportunities both in Ether terms and in dollar terms. And the growth potential for both the growth of the layer 2s themselves and the quantity of layer 2s is just off the actual charts. And then as soon as liquidity mining incentives get kicked in, man, it's layer 2 season, baby. And it's just right around the corner.
Yeah, absolutely. What we're saying, the big opportunity for ETH here, I think, with layer 2, the advent of layer 2s and the fundamentals look strong. And then there's a narrative opportunity with layer 2 season coming up as well. So that was only half of the layer 2 bull case. I think there's even more to cover. David, we're talking about a massive public goods opportunity, a secret $1 trillion opportunity. What are we going to cover in the next episode, and when's that coming out?
Oh, yeah, right. Well, first off, it's coming out tomorrow, so stay tuned. But, Ryan, there is this opportunity with layer 2s that no one is talking about. We just covered all of the basics, the Ether economics, the tokens, the bridges. People know about those things. There is a massive opportunity that no one knows about that is unlocking this new domain of crypto that has never been seen before. Like green pastures, untouched snow, and it's massive, Ryan. And it's about the combination of like Silicon Valley Web 2 startup incentives, but with public goods as the product. Crypto and Ethereum is here to do one thing, which is to solve human coordination. And what we are doing on the layer 2 ecosystem with block space rewards and what we are calling retroactive public goods funding is putting the startup potential, the upside equity of something like Facebook or Twitter or something massive, but we are putting it where the product is public goods. And there, Ryan, with all of these layer 2 block space sales, that turns into billions and billions of dollars of monthly revenue that can go into the hands of entrepreneurs building products that have never been seen before on the face of this earth. It's something that I am extremely bullish on, and I'm making a call to action to the Bankless Nation to get ahead of the curve, because the amount of opportunity that awaits in the layer 2 innovation field with this mechanism, which we are going to describe in part 2, is absolutely massive. Never before seen products coming from never before seen funding mechanisms. And I want the Bankless Nation ahead of the curve here.
So guys, you will have to wait until tomorrow. We're recording this episode in 2 parts. That'll be in part 2. It's coming out tomorrow. But for now, we'll leave you with a main action item at the end of this episode. Go get some of those opportunities. Opportunities in ETH, there's opportunities in layer 2, and the big action item is go explore. Go cruise through the neighborhoods, see which layer 2 you like, that you vibe with, that you want to start calling home, and go start settling there. You don't have to pick just one. That's the great thing. Maybe pick a few and experiment with them, but start to figure out where you want to live in this new layer 2 paradigm. Of course, risks and disclaimers, guys. None of this has been financial advice. ETH is risky, so is crypto, so are layer 2s, all of DeFi is. You could lose what you put in, but we are headed west. This is the frontier. It's not for everyone, but we're glad you're with us on the Bankless journey. Thanks a lot.
Hey, we hope you enjoyed the video. If you did, head over to Bankless HQ right now to develop your crypto investing skills and learn how to free yourself from banks and gain your financial independence. We recommend joining our daily newsletter, podcast, and community as a Bankless Premium subscriber to get the most out of your Bankless experience. You'll get access to our market analysis, our alpha leaks, and exclusive content, and even the Bankless token for airdrops, raffles, and unlocks. If you're interested in crypto, the Bankless community is where you want to be. Click the link in the description to become a Bankless Premium subscriber today. Also, don't forget to subscribe to the channel for in-depth interviews with industry leaders, Ask Me Anythings, and weekly roll-ups where we summarize the week in crypto and other fantastic content. Thanks everyone for watching and being on the journey as we build out the Bankless Nation.